Hi and welcome back. In this video, we'll go through some of the charts which have been included in the complete version of the DCF model, available in course materials. Graphical representation is always helpful. It highlights the trends and assumptions based on which the model has been constructed. These charts will automatically update if the model's scenario is changed, and hence represent a good tool to compare each scenario's assumptions and linearity. Let's start with the first chart, which is in the sheet Revenue and EBITDA. This is a combination of column and line charts. Historical and forecast figures are well separated. What we can see from the chart is that revenues experience a strong growth throughout the forecast period. The EBITDA margin is also slightly higher than the one observed during the historical period. It remains in line throughout the whole forecast period, which is fine. This is the optimistic scenario, and it is okay to have slightly better than historical results. Let's change the scenario to base case in the P&L assumptions sheet. See how revenue growth is not so steep? EBITDA margins are lower as well. Okay, so this chart shows us that revenue growth in the forecast period is in line with historical evidence. We also saw that the EBITDA margins are in line with the past and remain stable during the forecast period. Moving on to the next chart, which is titled Cash Flows, we are able to see the present value of cash flows and their actual value throughout the forecast period. Cash flows, which are more distant in the future, have a lower present value. Unlevered free cash flow development seems pretty linear throughout the forecast period, except for a slight dip in 2015. In the next sheet, we have a bridge chart, which allows us to compare the EBITDA in FY13 and the one in the first year of the forecast period, 2014. We can see that revenues and cost of goods sold grew in 2014. These two movements almost compensated each other. COGS increase prevails slightly, and this is the reason for the lower EBITDA value in the first year of the forecast period. It is always good to make this comparison and check whether the forecast period is in line with historical evidence. There should not be high jumps and strange movements. The next chart analyzes working capital. The three columns are the calculation of days for each of the three components of working capital, and the area behind them indicates the actual amount invested in working capital. We can immediately notice that there is a strong increase in the amount invested in working capital, while the number of days remains the same as the last year of historical evidence. This is explained by the growth of the firm's business throughout the forecast period. A growing business needs a higher amount of working capital. In the last sheet, we have three donut charts. Each of them shows the enterprise value obtained in one of the three scenarios. The enterprise value varies significantly based on the scenario. The optimistic case gives a valuation of $208 million, while the pessimistic case is at $101 million. It is normal to have a large difference in these results, as growth parameters influence significantly a firm's value. The donut breakdown gives a split of how much of the enterprise value is generated by cash flows throughout the forecast period, and how much is given by continuing value. In some cases, when the proportion of continuing value is too high, that could raise questions regarding the hypothesis with which it was calculated. Whether the perpetuity growth is not too high, for example. Our results show a balanced ratio between the value deriving from the 5-year forecast period and the one from the continuing value.